understand the challenges that people have in trying to figure out what to do with clients' money and figuring out strategies for the next, 6, 12 months. Did the Fed just make that easier or harder with their decision yesterday?
If you allow me to sound like an economist, I'd say the answer is they did both. They made it easier because I think they were clear about their current expectations. So yes, there was a pause or a skip, whatever phrase you want to use, but I think for planning purposes, the more important information was an expectation, not yet executed, of 2 more hikes. So easy because you have a sense of what the Fed's likely to do based on their own forecasts. Harder because, tighter financial conditions, more expensive money, all of that makes it maybe a little bit more challenging to figure out exactly where does one go. Are equities likely to be under pressure, or are we going to see a continuation of the rally that we've had thus far? Is the better bet, if you're a financial analyst, to put your money, or a financial advisor, to put your client's money in fixed income, which at this stage, the so-called risk-free rate, the Treasury rate now, could be pretty attractive. And so I think in that sense, it's both easier and harder.
Yeah, because, and I was having this debate with Joe Kernan a couple of weeks ago, saying, he was in camp Bitcoin and I was in camp T-bills. And it's not that you can't do a little bit of everything, but I look at these yields and I'm not even talking about 6-month or 1 years. I mean, on a 5-year Treasury bill, you can get 4% right now. Risk-free and with some tax advantages, I mean, am I crazy to think that sounds pretty reasonable? But then people would say, well, the Nasdaq's up 27% this year, so you're fired,
No, look, the answer is both things are true, which is for the first time in quite a while, it pays to leave some money sitting in riskless assets, a risk-free asset, the 5-year Treasury. On the other hand, we have seen some pockets where equity valuations are really very, very attractive. If you're one of those who put your client's money into an AI-type stock, let's call it NVIDIA as an example, they probably think you're a genius. And so I think the issue here, and many people have said this may be, for the first time in quite a while, a stock picker's market for those who want to stay in equities. And for those who aren't so comfortable trying to pick and choose winners and losers in that space, perhaps given how much the equity markets have run, sitting on the sidelines in a 5-year Treasury might be a smart move.
Do advisors need to worry that this is a little bit of a 1999 moment where people are going to come back in 6 or 12 months and say, how could you have had me in NVIDIA? And, I know it seems crazy to question now whether these companies, the Teslas of the world could crack. But do you worry at all about market conditions being like they were back then?
I think the main issue for advisors and for investors more broadly is to do 2 or 3 things. One is to have a perspective on where you are, where the particular client is on the risk spectrum. Do you have a client that's really willing to tolerate a bit higher risk, or perhaps not, given where they are in their life cycle or personal perspectives? Secondly, always important to remind clients around the value of diversification. And so the whole goal here for, I think, most clients and for most FAs is to use basic sense when it comes to having an appropriately broadly diversified portfolio. And the third thing, obviously, is for most retail clients, for all of them, avoid the temptation to do market timing. And so from my standpoint, that means advising clients to think about things like dollar cost averaging throughout the cycle. And so in order to avoid this notion of, gee, you made the wrong call, the answer is to advise clients on how to think through all of these investment choices with a long-term lens based on their own risk appetite.